Ladies and gentlemen, I want to say a massive congratulations to you guys that are still in the arena here with us. You are the hardcore Finance Malta annual conference because you are still here. This is the last panel discussion that we're coming to, and respect to everybody who's stayed with us. I have to say this, that the hall is still very full, so I'm very excited about that. But before we come to this final panel of the event titled Tax in a Changing World, Adapting to Global and Local Reforms, I'm going to welcome panel guest Joseph Caruana, Tax Commissioner, Malta Tax and Customs Administration, to set the scene with a keynote, and then hand over to moderator Dr. Juanita Brodok, founder, partner of Brodok, Grec Law, to lead the discussion. But right now I want to welcome Joseph Caruana, please, ladies and gentlemen.
Distinguished guests, esteemed colleagues, ladies and gentlemen. It is a privilege to address you today at the FinanceMalta Annual Conference, a gathering that brings together the best minds in finance, policy, and administration. The theme chosen for this session, Tax in a Changing World, Adapting to Global and Local Reforms, is one that is both timely and essential to consider as we navigate a rapidly evolving global landscape. The world around us is changing at an unprecedented pace. Digitalization, artificial intelligence, new business models, and the platform economy are reshaping not only how we do business, but also how we govern, regulate, and serve our citizens. For tax and customs administrations, this is a moment of both challenge and opportunity. Our 2023-25 strategy sets a clear vision to build a resilient, future-proof administration that is agile, transparent, and responsive to the needs of the Maltese economy and society. Within this context, MTCA has over the past 2 years undergone significant organizational structuring and invested time and money so as to create a modern, agile, and responsive administration. Today, we look ahead to our upcoming strategy. We reaffirm our commitment to transformation, anchored in technological innovation, a relentless focus on compliance and service excellence, as well as cooperation. We will therefore continue to draw on the collective wisdom of the Tax Administration European Union Summit, known as TADEUS, and draw on its multi-annual plan, as these provide a roadmap for all EU member states, including Malta, to align on strategic priorities and operational projects, leveraging best practices and shared projects. In particular, the multi-annual plans focus on operational cooperation and shared performance. Tools will be very useful in guiding our efforts to move beyond coordination towards true collaboration. This will help us in achieving our goals of being at the forefront of tax and customs administration in Europe. Within this context, let me highlight 3 interconnected themes that are shaping our transformational agenda. First, digital transformation. Digitalization is the cornerstone of our future, of our reform. There is the need to invest in robust IT infrastructure, adopt innovative digital approaches, and build cross-governmental ecosystem. For us, this means accelerating the deployment of seamless data-driven processes that makes tax compliance efforts for taxpayers and efficient for our administration. In this regard, we shall be implementing an integrated tax and customs administration system That is a multi-million investment to unify tax and customs processes and enable real-time analytics. At the same time, the phasing in of real-time reporting for VAT and payroll taxes is being explored with a view to align with the EU's VITA package. We have also had notable progress in customs operations, a key milestone being implementation of UCC IT systems. Additionally, national import system has been upgraded to achieve EU CDM compliance, and the automated export system has replaced the former national export system. Furthermore, UCC systems such as Certex and the national single window are scheduled for deployment by the end of the year. It also means leveraging artificial intelligence for risk management, taxpayer interaction, and reducing administrative burdens, while remaining vigilant about data protection and ethical use of technology. Here, SAS risk rules for VAT and corporate tax are operational, improving audit case selection and fraud detection. Furthermore, it means preparing our workforce for the digital era, ensuring our teams having the skills and tools to strive in a constantly evolving environment, and here, providing training to our staff is actively being pursued. Secondly, tax compliance. Ensuring compliance is at the heart of our mission. The tax gap, the difference between the tax due and tax collected, remains a critical challenge. Our strategy to tackle the tax gap focuses on using advanced analytics and new methodologies to monitor and reduce the tax gap across all taxes. Implementing a mix of interventions from targeted communication to robust enforcement to stimulate voluntary compliance and prevent non-compliance. And collaborating with other EU member states and the third country to tackle cross-border fraud, particularly in areas like VAT, e-commerce, and missing trader fraud. As part of the Tadeusz multi-annual plan, projects relating to estimations of tax gap in relation to personal income tax, corporation income tax, and VAT, e-commerce, as well as initiative on immovable property assets in cross-border transaction, can provide us with tools and data needed to close the tax gap and in the process help us build public trust. Thirdly, the implementation of EU legislation and administrative cooperation. We live in a complex world, and tax legislation reflects the complexity. And the need for effective administrative cooperation has never been greater. Our priorities therefore include ensuring timely and effective implementation of key directives such as DAC 8 and VITA, and participating in projects that enhance the use of data exchange under international frameworks and improve the performance of administrative cooperation. Looking ahead, as we formulate our next strategy, we are guided by the lessons of the past and the imperatives of the future. Our approach will be resilient, building systems and processes that can withstand internal and external shocks, from cyber threats to global economic shifts. It will be inclusive, integrating all stakeholders, businesses, citizens, and international partners into our transformational journey. And it will be innovative, embracing new technologies, methodologies, and partnerships to stay ahead of emerging risks and opportunities. To conclude, ladies and gentlemen, transformation is not a destination, but a journey. It requires vision, collaboration, and the courage to embrace change and cultural shifts. MTCA progress demonstrates that even small administrations can aspire to lead in innovation, governance, and service excellence. I invite you, all of you, policymakers, practitioners, and partners, to join us in this endeavor. Together, we can build a tax and customs administration that is not only fit for today, but ready for tomorrow. Thank you.
Good afternoon, ladies and gentlemen, and welcome to the last panel of this conference. I have the honor and the pleasure to moderate this panel, which focuses on international taxation. And in a whirlwind manner, we will attempt, in the allotted time, to provide you with an overview of developments which are taking place as we speak in this very dynamic sector. My name is Juanita Brogdorf. I'm a partner at Brogdorf Grech Law. And joining me, I have an illustrious set of panelists and who need no introduction. Having said so, I will simply refer to the name, the Commissioner for Tax and Customs at the MTCA, Mr. Joseph Caruana. Next to me, Aldo Farrugia, Director, Legal, Technical and International at the MTCA. To my left, Professor John Vella of the University of Oxford, and also Director of the Center for Business Taxation at Saïd Business School. And we are honored to have among us today Benjamin Angel. Benjamin Angel is the Director of Taxation and Customs at DG Tax Ud, basically the Commission's department or directorate for taxation. So we'll dive right in. Commissioner, you mentioned Thaddeus, you alluded to Thaddeus in your presentation, in your keynote speech. Now, the first topic, in fact, which we've chosen for today is digitalization of tax administrations. And I'm curious to know, having attended Thaddeus, what your experience has been, shared or perhaps a different experience to your counterparts in the other tax administrations, and also how your strategy, the MTCA strategy, dovetails into the multi-annual program of Thaddeus.
Yes, I refer to Thaddeus. I attended last week the session. It was. I am always look forward for this plenary to the fact that you'll be able to meet all tax administration from the different member states, together with obviously the Commission, that are leading the transformation and implementation of tax administration. Obviously, I look forward for this annual event, because it places, it is a very good platform to share best practices, to go through the annual plan that is a revolving plan that is improved every year through the participation of a number of projects from member states. And the main cross-functional was digitization, compliance, and EU legislation and administrative cooperation. Those are the main three topics, whatever. There were a very good discussion on emerging technology like AI and all for cybersecurity. In fact, the fact of these new challenges will bring. And obviously, I had the opportunity to benchmark, our actions that I need to say in this couple of years. We have a strategy that will be at the end of it this year, and we are planning for the next 5-year strategy, wherein digitization is key to our transformation. dictated by the OECD Administration 3.0, wherein also other member states are following, and therefore we're talking on real-time reporting, on data-centric organization, on voluntary compliance and risk management, and compliance risk management in the system. And obviously in that level, and also in the second team was on compliance, tax compliance. I made it a point as soon as I was appointed even commissioner that our focus will be on compliance. I think we are changing the mindset, and the results are that we have much more taxpayers becoming compliant, and there is more reach out, to taxpayers in order to support them and ensure, because after all, we are after giving an excellent service, a service to the client, and yes, why not? We have a duty to reduce bureaucracy, to implement systems and procedures that are efficient and that respond to our clients, that is businesses, and therefore ensuring competitiveness.
Thank you for that. And of course, in ensuring that Malta becomes, the MTCA in particular, becomes more resilient and future-proof, perhaps we could delve into the more granular detail with you, Mr. Farrugia, on what you see the actual implementation of the MTCA strategy panning out to be, and what this means really for taxpayers, what it means for the jurisdiction.
Well, over the last few years now, many changes have been going on within our administration. We kicked off with the strategy, 3-year strategy. We're in the last year now of the strategy, and we're working on another strategy for the next 2 years. We have seen changes in the setup of the administration itself. The organigram has completely changed from 4 or 5 years ago. We have new directorates, and we'll continue to build on that. The process is certainly not ready. We've moved from a kind of a law-based structure towards a more function-based structure. We've introduced, for example, we launched the large taxpayer office. We introduced mechanisms for risk management. Obviously, because of all these changes, we also have included change management, because it's quite a radical change that we're going through. And also we're working, because it goes hand in hand with all this change, on legal changes as well. We're trying to rationalize and consolidate legislation as far as possible, always keeping the taxpayer in mind. The whole concept is taxpayer centricity. In the final end, that's the core of all these changes. And I can't not mention, obviously, the Commissioner mentioned as well, the changes and the implementation of technologies. I'm sure many of you have heard that we have acquired AI tools. Now we'll be acquiring an integrated tax and customs system. Again, all this to keep the taxpayer as the center of it all and the service towards the taxpayer. The Commissioner also mentioned in this regard the real-time, the drive towards real-time reporting as well. So a lot of changes are going on, and I would like to add to this, of course, stakeholder involvement. Over the last few years, we have involved stakeholders more, with a view to get the perspective, all the perspectives to make the right decisions, even in the changes that are going on.
Thank you for that. And one of the aspects, of course, which was central to the very actual summit itself of Thaddeus is cooperation amongst tax administrations. And for this, I turn to you, Mr. Angel, because, of course, clearly the exchange of information amongst member states is key to the success of the European Union as a whole in enforcing its tax systems. And I was wondering, of course, how much of the DAC 6 recast we will see in the forthcoming years.
Thank you. It's more than a DAC 6 recast. Actually, it's a DAC recast. So we are doing a recast covering DAC 1 to 9, not only DAC 6. We are trying to have a systematic approach to simplify the DAC first. It has become quite difficult to read because those 9 different DACs have been sedimented over the years. So all the efforts you have made in the room to remember which one is DAC 2, 3, 4, 5, 6, 7, 8, 9, wasted. There will be only DAC 1 as of next year. We need also to take into account the progress which has been made in some fields at the OECD. For instance, the OECD has agreed now on new modalities to exchange information on beneficial ownership for real estate, and that needs to be factored in the DAC, which is our standard instrument to mirror the international development. Now for DAC 6, this is indeed a very difficult nut to crack. We have announced that we will do simplification, and DAC 6 is probably the one DAC that raises more issues and more questions all over Europe. The standard criticism of DAC 6 is it's unclear. The hallmarks are obscure. The member states have interpreted the hallmarks in a very different way, and then we end up with relatively unleveled playing field. So we need to revisit the hallmarks to try to clarify them. We need also, going forward, to have a little bit more collective guidance on how to interpret them. As far as DAC 6 is concerned, we need also to revisit the legal professional privilege. The European Court of Justice has given indication on who is covered and was very clear that the only profession that is covered are the attorneys which are active in court, no one else. I mention it because in some states they have been a bit too generous in extending the legal professional privilege, and that will need to be factored in DAC 6. We will also work on some other feature aiming at facilitating the cooperation between tax administration and facilitating the use of the tax data. These are more technical things. But exchanging information is one thing, but since Joseph has mentioned Thaddeus a lot, let me say, as co-chair of Thaddeus myself, that we need also more trust between tax administration. And this is one of the elements that Thaddeus is supposed to help addressing. We can see when we discuss some legislation that sometimes decades after the accession, or for some half a century after they joined the European Union, they still don't trust each other. You know, when we were discussing, for instance, our draft legislation on simplifying the life of SMEs, we were supposed to have some kind of one-stop shop where you get the money and you send it then to the member states, which is supposed to get at the end. And in Council, we had plenty of member states telling us, but how can I be sure that the other will send me my money? I think we need to go beyond those kind of reaction. So one of the value of Thaddeus is that people know each other, the head of tax administration know each other, they know whom to call if they have a question, a problem, and they start trusting more each other, because without trust, we cannot make progress in having an effective tax cooperation.
Thank you for that. And in fact, you rightly mentioned that there were so many iterations of DAC, and now there hopefully will be simplified. And that actually brings us to the second major theme, which is developments at a European Union level. And we've just seen the release of the work program of the EU Commission for 2026. And if there is one major theme, I think, over there, that would be simplification, decluttering, making Europe more competitive. If we were to look at and categorize the three types of initiatives, we have new proposals, we have existing proposals, and then we have some proposals which have been withdrawn. And amongst the new proposals, of course, the omnibus package is one which focuses on simplification. What, perhaps, could you tell us more as to where this package is leading, what's driven it, not just the omnibus package, but also the withdrawal of some directives, proposals for directives, and others which survive and which are still in the pipeline?
Yeah, well, we withdrew some directive because you need unanimity in taxation, and sometimes you get it, sometimes you don't. So after a while, when you're running in circle, you need to draw the conclusion and move on. So that's a normal sanity reaction. Now, as regards the simplification process, we have started discussion with a number of players. On the one hand, stakeholders, on the other hand, member state. Stakeholders, we have a specific consultation platform, which is called the Tax Good Governance Platform, which gathers everyone basically from Business Europe to Oxfam. And with member states, we have put in place dedicating working group to start discussing options for simplification. What we're doing is a systematic review of all the tax legislation at the EU field in the area of direct taxation. So the parent subsidiary directive, the interest and royalty directive, the dispute resolution directive, the two anti-tax avoidance directive. Not faster because it is still being implemented by member state. Not Pillar 2 because the simplification is being discussed in the OECD. And the DAC is a separate exercise. One of the big tickets is obviously the anti-tax avoidance directive. On the anti-tax avoidance directive, we are discussing very far-reaching options. For the interest limitation rule, we are discussing, for instance, whether to exempt SMEs, whether to exempt third-party loan, whether to exempt some sectors completely for a certain period of time. Let me give you an example. Defense. At the moment, all the European government is asking the defense sector to step up massively their investment, to build new factories, because we need more ammunition, we need more tanks, we need more planes, we need more drones, but we have a limit to their debt financing. Maybe we should consider lifting this limit for a certain period of time to make it easier for them to answer the call. We need also some clarification on areas like financing of infrastructure. We have mentioned in the directive, but it's not clear what is covered, basically. We need to tackle the procyclicality, because one of the unpalatable aspects of this rule is the deductibility is limited to 30% of the EBITDA. But what it does mean in practice is when a company is in trouble, its profitability goes down. And at the very moment where its profitability goes down, then it eats more quickly the ceiling of deductibility of interest. So instead of being counter-cyclical, it's pro-cyclical. It worsens the situation of the company. We should also reconsider the ceiling. At the moment, there is a de minimis threshold of 3 million euro, which is very relevant for Malta because you have plenty of SMEs. This 3 million was decided in 2016. If we had an indexation mechanism in place, it would already be 4 million today. So we need clearly to have some kind of indexation mechanism and revisit whether the thresholds are the right reference that we need. In the anti-tax avoidance directive, there are also the control foreign company rules, the CFC rules. Question, should it apply to SMEs? more important question, should we apply it to Pillar 2 companies? Because Pillar 2 is already ensuring some kind of CFC rules in a different manner, and the business community is clearly asking us to take it into account. In the anti-tax avoidance directive, you have also something called the general anti-abuse rule. Should we work on some kind of collective guidance? Because de facto, this has been interpreted in a very different way by countries. So these are examples of things that are being discussed. On the parent subsidiary directive and interest royalty directive, we need also to spend some time on bringing further improvement to the issue of withholding taxes. We have already brought simplification and improvement via FASTER, but we can do better. So we're trying to have real changes. The difficulty that we face is behavioral. All member states support simplification as long as there is no proposal on the table. The minute there is a proposal, then they discover that actually they're not so sure that they want to simplify. So on each and every aspect that I mentioned, we have 8, 9, 10 member states that say they're against it. And we need unanimity. I have member states telling me, as I mentioned to Joseph this morning, we support very strongly simplification, but on 2 conditions: no impact on our tax income and no impact on our tax IT. I just cannot find anything that has no impact on any of those 2, to be honest. So we need member states to walk the talk. That is very important. And we need the business community to also engage in this process and also talk to their respective government and help us pushing for a simplification.
Thank you. And insofar as you're trying to persuade the member states the EU Commission as the one coming up with proposals and then amending those proposals, and clearly you would be open to feedback, and a variety of amendments do actually take place to the text. And how do you gather that feedback in a practical manner? And how do you integrate it? Because some of it is obviously going to be also contradictory. And also, what about impact assessments? How do these fit in your work?
Well, I've been working for the European Union for more than 3 decades. So I can tell you, on whatever topic you're working on, you hear always everything in its contrary. It's normal. Europe is diverse. People have diverse interests. And it's part of a good consultation process, actually, when you gather opinion from all sides, because at the end of the day, you get a much more granular knowledge of the policy. So how do we do it? We have different ways. We have public consultation, which are a structured questionnaire that we put on the web, and then anyone can answer. There will be public consultation for the simplification process, which will allow to any individual or company to answer. This tool is used with very variable degrees. Sometimes there are legislation for which, in a public consultation, we get a super small number of answers, like 100, 150. Sometimes we're flooded because NGOs like the idea, and then suddenly we get 30,000, 40,000, 50,000 answers. Quite unpredictable. We have the structured discussion because all groups have their European representative. So the accountant, for instance, they have Accountancy Europe and CFE. The businesses, they have Business Europe, the International Chamber of Commerce, Eurochambre, etc. So in those groups, they have their respective tax committee, they work on suggestion, and they pass it to us. Sometimes we have groups or individuals writing to us spontaneously without any process. Feel free. Academics, obviously, have always plenty of interesting publication and useful views. And last but not least, member state. Because we may have all the good ideas in the world, but if at the end of the day we don't get unanimity, we achieve nothing.
That's very true. You mentioned and you alluded to one of the pillars, which are the result of the BEPS2 project, which is Pillar 2. But perhaps I'd like to mention something about Pillar 1 first, because this pillar has been pushed, but it has perhaps reached a standstill, perhaps an indefinite standstill now. And yet, there are some member states, which, like Poland or Belgium, which are going it alone. And in spite of the fact that, for instance, Commissioner Hekstra mentioned that Europe as a whole would like to proceed via multilateralism. What do you think would be, and this is obviously a question also to the others, what do you think would be the implications if this were to happen, if we were to have DSTs, if we were to have a digital presence as a new nexus, as an extended nexus in some member states and not in others? What would be your take?
Well, the Commission had made some proposals in 2018, both for a DST and a digital presence nexus. It didn't get unanimity at the end, but it did inspire some member states, so France, Italy, Spain and Austria, to some extent drew inspiration from what is on the table. Those proposals were not intended to be permanent, they were intended to put pressure on the international negotiations so as to have a multilateral agreement on finding a solution for the taxation of the digital sector, which indeed is Pillar 1. The member states which have a DST have committed to take them out if and when Pillar 1 kicks in. This commitment was time limited, but in essence, politically it is still there. You're right that we have now one extra member state which is openly considering introducing a DST, which is Poland. Our preference at the moment, and I'm saying it after careful consideration, because we have considered ourselves having a DST as an own resource, for instance. Our preference is to have, if we can, a multilateral solution. You can see that DSTs answer a real need for taxing the digital sector and some difficulties in doing it. But a world where you see a multiplication of uncoordinated DSTs is a world where you would have plenty of double, triple, quadruple taxation and tax dispute. So clearly, a multilateral solution is better. Where do we stand with Pillar 1? The honest answer is I don't know. On the first day of the Trump presidency, there was an executive order saying, we don't want it anymore. And then 3 months after, the US representative in the inclusive framework said, actually, no, we want to fix Pillar 2, and once we have an agreement on Pillar 2, we resume the discussion on Pillar 1. Are they genuine? Do they mean it? Do they really want to have an agreement on Pillar 1? I don't know. I can't speak for them. Time will tell. We will see next year. But for us, if we can, it will be the priority. It is also discussed in the United Nations in the first protocol, which is supposed to cover the taxation of cross-border services. But we have a preference for the OECD framework, if only for one obvious reason. The US are in. The US have walked out from the United Nations process entirely, and what is the value of an agreement on the taxation of the digital sector that would not include the United States and the US companies? So clearly better to have them in.
Very much so. And in fact, that ties in very neatly with Pillar 2, on which the US has also withdrawn its support. So we have, in terms of Pillar 2, we have what is a successful Pillar 2, insofar as we have over 60 countries which have implemented it. But at this juncture, we seem as a globe, perhaps, to be hesitating, because, of course, the largest country in terms of economies has pulled back. And as a result of that, we have had the G7 agreement to make an allowance for the United States, or the so-called side-by-side agreement. Perhaps, Professor Vella, I'll ask you, and then I'll ask all the panelists as well, to reflect on the implications of not having an agreement, not reaching an agreement, reaching an agreement. Does that address the elephant in the room?
Yeah, so I can see some of my friends in the audience who aren't tax experts, so just to give them a brief background. In October 2021, over 140 countries agreed to this global minimum tax, referred to it as GLOBE, which ensures that multinationals pay a minimum level of tax in every country in which they operate. The US has its own global minimum tax, known as GILTI, and the US agreed to the October 2021 statement, but after Trump was elected, as has just been said, the US basically reneged on its October 2021 agreement, and it threatened that it would impose retaliatory taxes on any country which imposed the global minimum tax on US multinationals. So there was a period of uncertainty, but in June, the G7 reached an agreement, and the agreement was the side-by-side agreement, which basically said that countries would not impose the global minimum tax on US multinationals, and in return, the US would withdraw their proposals for retaliatory taxes, so-called Section 899 taxes. But as I said, the October 2021 agreement was reached by over 140 countries. So now the G7 agreement basically is before these 147 countries, and the question is, will they sign up to this agreement? And as far as I understand, the US is pushing to have a solution of this issue before the end of the year. Now, so the question arises, will these countries sign up to the G7 agreement, yes or no? And there are a number of considerations here. So the first one is, some countries might be worried that the side-by-side agreement, so where the US multinationals are subject to GILTI, whilst all other multinationals are subject to the global minimum tax, gives US multinationals an unfair advantage, because GILTI, it might be thought, is less onerous than the global minimum tax. Now, there are reasons to think that GILTI is less onerous than the global minimum tax, because for the tax people in the room, GILTI employs global blending, whilst the global minimum tax is done on a country-by-country basis. On the other hand, there are other issues on which there are other features of GILTI which make it more onerous than the global minimum tax. For example, GILTI does not have a substance-based carve-out, whilst the global minimum tax does. So it's actually not as simple as to say GILTI is definitely less onerous than the global minimum tax, but it is reasonable to consider whether it is or not. And so that's an open question, actually. But there are other considerations. So firstly, there are large G7 countries which have not put their position clearly yet. So we can think of India, China, Brazil. We don't know if they're going to ask for something in return for agreeing to the G7 agreement, and whether other countries would agree to that. There are questions. If I was a member state deciding on this, or any other country, I would say, okay, if we agree to this, is there any guarantee that the US administration will not come back in a few months or years and say, okay, we want something more now? And there's also in the side-by-side agreement a commitment to revisit the treatment of tax incentives, or think about whether we should revisit that. I mean, the thing is, if the way tax incentives are treated on the globe is loosened significantly, then you create such a hole in the global minimum tax that the question arises, is it worth having the whole thing in the first place? So there are questions as to whether these 147 countries will sign up to the G7 agreement. I'm not sure. On the other hand, the alternative, either you sign up to it, or else the US will impose retaliatory taxes, so it's not a great choice. Even if they sign up to it, then the question is the side-by-side agreement something which does it provide a stable equilibrium? Now, my view was that GLOBE provided a stable equilibrium, but I'm not sure the side-by-side agreement provides the same stable equilibrium. And why? Because if certain countries, such as Ireland, Singapore, Switzerland, repeal part of the GLOBE machinery which they introduced. For the tax experts, this is the Qualified Domestic Minimum Top-Up Tax, the QDMTT. If they do that in order to attract US inward investment, then that could lead to a chain of events that could even potentially lead to the collapse of GLOBE. So I'm not sure if the 147 countries will sign up to the G7 agreement. If they do, I'm not sure the side-by-side agreement will be a stable equilibrium anyway. But the choices faced by countries aren't easy, and they're difficult ones.
Yep. I'll leave perhaps the last word on this to Mr. Angel, but Mr. Farrugia, what is your take in terms of, again, there have been two main, perhaps, objections to the side-by-side agreement. One is the legality of it. How do we impose it on a directive which has already been enacted amongst the member states? Do we need an amendment of the directive? So there are the legal, procedural aspects, but then there are also the matters of competition. And will Europe remain competitive with or without an agreement? What is your take on this?
Well, in our view, I mean, whatever it does, it has increased complexity, for sure. Something which was already complex now is becoming even more complex. And I know that there is a race to try to agree because for the sake of stability within the world. As such. I also understand that any agreement will be through some form of guidelines or something like that, which means that these will be imported wholesale into our directive. And that is for us a little bit of a concern, whether it's a sustainable situation. So we do have some concerns on the question of complexity, competitiveness. John has referred to this already. I mean, is guilty more better than our system, Pillar 2, or vice versa? I think time will tell. I mean, it's quite guilty is quite complex in itself. So. But in terms of the added complexity and the sustainability of it, of how it is imported into our law, that are two concerns that we do harbor.
Mm-hmm. Mm-hmm. And of course, the last word to you, Mr. Angel. In this case, you probably have seen a reaction even internally within European member states. Even after the last ECOFIN, Estonia made a statement where it says, basically, we need flexibility. What is your vision for Europe in terms of Pillar 2, in terms of a side-by-side agreement?
Thank you. Well, first, a clarification. I don't want anyone to have the impression that the United States have walked out of Pillar 2. The reality is that they have never walked in Pillar 2. Even with the Biden administration, what we were discussing is how can the two systems coexist. There was never a plan to drop guilty. If anything, the Biden administration has even added to the complexity by adding another legislation, which is the corporate alternative minimum tax, which applies to all the US MNEs with more than 1 billion turnover. If you compare the two systems, our view is that they are broadly comparable. Obviously, there are differences, but in terms of complexity, Pillar 2 is complex, too complex. We need to simplify it, but the US system is even worse. The three legislation that they have, guilty, CAMT, and BEAT, it's 1,725 pages of legislation, not even using the same accounting principle. It's extremely complicated. If you could look at the compliance cost, there's an interesting study which has been released not so long ago by the Tax Foundation on the compliance cost for EU MNEs of Pillar 2, and they concluded, in average, 255,000 euro per group per year. In the United States, for the similar legislation, is 9 million. In other terms, it's 16 times more expensive, according to the Tax Foundation figures, not our figures. So, clearly similar. In terms of effective tax rate, very difficult to draw a firm conclusion here. The answer is it depends on the sector. The estimates are usually somewhere between 14 and 21, 22. But even 14 is just 1 point below the one we have under Pillar 2. Within the European Union, the variation is much bigger. We have countries just at 15, and we have countries at 25, 26, 27. So that is to be taken into account. On the side-by-side, we therefore think that there is a case, and we can make it happen without any damage for anyone. Now we have to obviously avoid a multiplication of side-by-side agreement with plenty of jurisdiction, because we would lose the level playing field effect that we hope to get from Pillar 2. From a legal point of view, what is being discussed at the moment is importing it via safe harbors. So we have a package under discussion at the moment with a side-by-side safe harbor for ensuring the coexistence with the US system, a permanent safe harbor, which is a major simplification of the rule. And the two will come together. We do not need to change a directive because we have in the directive an article called Safe Harbor, Article 32, which foresees that the safe harbor which are covered in the directive are those which are internationally agreed, with one condition: member states must have consented to it. The EU member states must have consented to it. So it's not anything, it's something that the 27 have agreed to. There's nothing new in this article. We have already several safe harbors, like the UTPR safe harbor. We don't implement the UTPR safe harbor now. And all member states which implement Pillar 2 have imported the safe harbor via this Article 32. So we are not inventing any new mechanics, we're just using again a mechanics which is already in the directive. What prognosis can we make? Well, there is a big effort at the moment to try to finalize the discussion before the end of the year. Also, because there are big rendezvous clauses in our legislation, we're supposed to start implementing the UTPR on US companies on the 1st of January, and it is clear that it would create a mess and renewed tension if we were to get there. So there is a collective interest in trying to find a balanced solution on time. I'm optimistic by nature, so I would rather bet on an agreement to be found in the coming weeks.
Okay, let's keep fingers crossed. And I'm conscious of time, but I'd like to invite all my panelists, perhaps for some concluding remarks in terms of finding a balance, the very fine balance between tax transparency, tax fairness, and tax competitiveness. Please, perhaps we'll just take it from you, Commissioner, first.
If I conclude, I think the points, the principles that you mentioned are the key in our transformation that we are doing. We are after transparency, accountability, and efficiency and effectiveness in the operation to provide an excellent service to our clients, and our transformation and investment that we're doing. We look forward to be a trusted tax administration, and effective.
Thank you.
Well, from my end, the concepts that you've mentioned are part and parcel of the international scene. A scene which is, in my view, harbors a number of contradictions. You've got globalization and tax sovereignty on one side. You've got complexity and the need for simplicity on the other side. You've got digitalization, but laws that still cater for analog rules. But so it's an interesting situation at the moment. I don't think it's going away anytime soon. But Benjamin mentioned optimism. As Alexander Pope once said, hope springs eternal. I believe that the contradictions, no matter how strong the tensions they create, they contain the seed of their own resolution. So I think eventually things will get resolved.
Okay, thank you. Perhaps Professor Vella?
Yeah, I mean, I don't want to be the only non-optimist on the panel, but you know, since the financial crisis of 2009, international tax policy debate and reform has really focused on things like profit shifting, addressing rising inequality through changing the way you tax capital, etc., etc. I mean, these were not the exclusive focus, but they really dominated the debate, and they're all important issues, and it was, you know, important that they were addressed. But I think we had, you know, for the past 20 plus years, we really have not given as much attention to things like competitiveness and growth. And, you know, and if you think about competitiveness and growth, and you look at the Draghi report from September 2024, that makes for really chilling reading. So I recommend this to everyone in the room. It's an excellent report prepared for the Commission, but it's also extremely worrying. The Draghi report shows that Europe is facing an existential threat, challenge. Europe is lagging behind in terms of growth and productivity. Just to give one statistic, I think per capita, real disposable income grew twice as fast in the US as it did in Europe since the year 2000. I mean, that's shocking. And Europe is also lagging behind in terms of innovation. Especially in so far as advanced technologies are concerned. If you look at the top 50 tech companies, only 4 are European. And now with the advent of AI, this could be a real inflection point in economic history. And as far as I can tell, the debate is whether China or the US will win the AI race. I don't think Europe is in the race at all. So that's all negative. The positive thing is that the Commission has asked Mr. Draghi to produce this excellent report. So it shows that the Commission is taking this seriously, the authorities are taking it seriously, and they're looking at it with clear eyes, which is great. But we need to really address these challenges. And coming back to tax is not a silver bullet. Tax should not be thought of as a silver bullet, but clearly tax has to be part of the conversation on how to address these really important challenges.
I agree with you. The Draghi report has been widely praised. And last but not least, Mr. Angel, your thoughts?
I agree with what John said. And obviously, no one likes taxes. But without taxes, we wouldn't be in this room. We would all be living in caves, basically. All governments have to find the right balance, and it's a difficult one. On the one hand, you cannot overdo it with taxes, even though there has been a strong evolution. We tend to forget, for instance, but even in the United States, until Ronald Reagan, the CIT was above 50%. 50%. But at the same time, all government needs tax income to finance the infrastructure. And competitiveness is not only about tax. Competitiveness is about a number of drivers taken together. If you want to attract FDI, you should not overdo it with taxes, but you need good infrastructure, you need good labor force, you need a well-functioning court system, you need law and order, and you need tax resources to finance it. If you just cut taxes and have very bad infrastructure and no rule of law, you will not attract any investor, or certainly not the one you want. You might attract some fishy money, but certainly not real investor. And that is a very difficult balancing act for all government. If you look at the countries those last 10 years in the OECD, which have attracted the highest volume of FDI, the answer is the United States, Germany, and France. None of those three are low-tax jurisdictions, very clearly. Some member states in Europe have very low taxes and are struggling to attract investors, which show that taxes matter, but only to a certain extent. Too often, cutting taxes is a shortcut for lazy politicians, because it's easier to cut taxes than to do the real reform to make the country more competitive and more attractive for investors. We need, therefore, a package when you think about competitiveness. As John says, taxes are not the silver bullet.
Yes, thank you. And in fact, I think that shows that Malta is on the right track then, because this is what we attempt to do, which is basically, as a jurisdiction, have the complete package, where tax is one aspect, but definitely not the only aspect. For any jurisdiction, I think that applies equally, that it is one tool in the bag, but not necessarily the rest of the bag and the rest of the tools. So with that, I would like to thank all my panelists for their intervention. And I'd like you, dear delegates, to join me in a last round of applause for my delegates. Thank you so very much.